Hello, everybody. My name is Erik Schatzker. I am an editor at large here at Bloomberg Television in New York City. I'm delighted to see you all and to welcome you to the Milken Global Conference panel on private markets. Before I introduce our panelists, let me just go through some quick housekeeping. Because this is a virtual panel, there isn't a whole lot of housekeeping to be done. I don't have to tell you to turn off your cell phones. But I do need to instruct you to do a couple of things. The first is, if you have trouble with the feed, refresh your browser. That's generally the first thing to do. And the second thing to do, and the third thing to do, if for some reason you're having some reception difficulty. The other thing I'd want to point you to is the dialog box on your screen that allows you to send questions my way. I will be fielding the questions, and I will do my utmost to get them through to the panelists in the course of our conversation. Just to be clear, I'm not reserving a space of time at the end of the hour to do audience Q&A. I'm going to do my best, as I say, to weave those questions into the context of the conversation we're having with this distinguished group of panelists. So let me introduce them to you. We have Scott Kleinman. He is the co-president of Apollo Management. Virginie Morgon, who is the CEO of Eurazeo. Raymond Svider, who is the chairman and partner at BC Partners, and David Taya, who is head of private equity for North America at Investcorp. Collectively, this group, so highly experienced in private equity, as you probably are aware, collectively manage hundreds of billions of dollars. So there's a lot of weight, power, influence, experience being brought to bear in the course of this panel discussion on private equity and private markets. Let's begin, shall we, panelists? I want to start in what I think is an obvious place, an overview. I want each of you to give me a sense of the deal-making environment that you see right now. The challenges of putting dry powder to work, for example. The kinds of opportunities that you see, and your outlook for the weeks, months, quarters, and years ahead. It's asking a lot. Will give us a sense of where your head is at right now. Virginie, would you mind beginning?
Thanks, Erik. Thanks for having me. Very nice to be with all my partners and friends for this session. So let's start, Erik, with just a few comments, and I'll then deep dive into the deal flow. I see 2020 as a very special year of awakening and polarization. And those two highlights of the year 2020 drives a lot of insights as to where we at Eurazeo see the deal flow coming. The polarization I see on two fronts. I see polarization of sectors, the big winners in tech, the weight of technology in some stock exchange index, and of course, some of the very heavily impacted companies and sectors, not to mention leisure and travel as example. I also saw another polarization, which I'm not sure we completely weigh in, and we should in our investment strategy, and it's about polarization, geographical polarization, where clearly China is making its way out of the peloton with strong growth for 2020, 2%, it says, compared to -4, -5, -9% GDP overall for many other countries. So we're thinking from a deal flow perspective that we've already made bet on high tech and growth type of investment. It's already about 25% of what we do at Eurazeo, which means about 5 billion of investment in technological companies, digital-minded, digital native. I think there's much more to be done in this direction from an investment perspective. We also like at Eurazeo some of those old sectors which will come back. The question is when. And we know a lot about leisure and hospitality, and we are spending time in analyzing some opportunity in that sector. China, for me and for us collectively, has always been a strong driver of growth for our investment, being European investment or US companies. We signed that agreement with CIC some months ago, which of course we're leveraging as we speak. And from an investment strategy or theme perspective, where you have a Chinese angle being a US or European company, just play it. So these are the two comments about the polarization. And maybe I'll come back later to leave ample room to my peers and friends to come in about the awakening of the year 2020.
There will be plenty of opportunity for that, I can guarantee you, Virginie. David, same for you then. Could you give us your sense of the deal-making environment, what you're doing, how you struggle with the challenge of deploying dry powder, your outlook, and the kinds of challenges that you're trying to weigh in making those investment decisions?
Sure. Thanks for having me. Hello to all my fellow panelists. A little bit similar to Virginia, I think it's always important, but now so more than ever, to apply the macro to the micro. And that applies similar to the other panelists. We operate in North America, in Europe, in Asia, in India. So it applies to geography. It applies to asset class, whether it's PE, real estate, or credit. And it applies to sector. And there clearly are increasing differentiations across all of those dimensions. I think as we think about private equity, a couple of themes are emerging right now. The obvious theme that everybody's talked about is the increased importance of technology, as evidenced by things like virtual conferences, but it obviously goes well beyond that, in making sure that companies you invest in have the capabilities to harness those leverage points from technology. Growth continues to be at a significant premium, and I think increasingly people appreciate the importance of human capital. All of this is with the backdrop of very robust pricing in the private equity market, and I think it really drives to the importance of focusing really intently on risk-adjusted returns. We don't think about a point outcome, we think about a range of outcomes, and in a very highly priced market, which is driven by the things we all know. Tremendous amount of dry powder. Deal volumes, while they've come back pretty meaningfully, are still lower. Scarcity of quality and the desire to earn appropriate returns for our investors. So we are trying to maintain our discipline around what we invest in, what growth and service focused middle market investors, and aggressively go after those assets that we really covet.
David, thank you. Raymond, your overview, please.
Thank you, Erik, and good to see you, and good to be here and see my fellow panelists. From my perspective, at least, we should not lose sight of the big picture. Clearly, 2020 is a very atypical year, unprecedented pandemic across the world, which has decimated some industries, and conversely, some industries and some sectors have benefited from it. If you're an investor and you've been there for a long term in investing in private equity, the silver lining to me, which we all know about, is that investing post a crisis, whatever it is, has proved to generate very, very attractive returns, to the extent that obviously you know what you're doing, and to the extent that you remain disciplined, as David was reminding us, rightly so. And so, to me, first of all, obviously it's very easy to be, to find it difficult. This is a difficult environment. This is a very uncertain environment. It's very difficult to, understand the risk reward. It's very difficult to price an asset in an environment where public markets are just, pretty much defying gravity in so many respects for a lot of reasons. But, that is not necessarily something that can be expected to last very long. However, despite all of this, I think we should all know and remind ourselves that the next 2 or 3 years are probably going to be very, very good periods to invest in, because if you look at any point in time in the past, in 1992, in 2000, 2001, obviously in 2008, 2009, the period of investing post a significant crisis has proved to generate good returns. Clearly, there's some sectors that are more stable, tech, technology in general, healthcare, business services, and those, and at least in our view, this is probably where the opportunities or the best opportunities are going to be. But that being said, we should all keep in mind that there's going to be lots of things to do, and that it's from our perspective at least, it's a very, very good environment to invest in. I'm not personally that concerned about dry powder. I'm talking about this because I'm mentioning this because you talked about it. I think our industry has learned a lot from the last financial crisis. We've all become collectively much more disciplined. And even in today's environment, if you know what you're looking for and you're disciplined in your approach, you can find investment opportunities that are worthwhile putting in the portfolio and building conviction upon.
Super, Raymond. To round out the overview, Scott, how about you share yours with us, please?
Sure. Thanks, Erik. And look, I think my fellow panelists have made a lot of the key points already. I guess the one thing I would add, though, or maybe contrast, while the perception that valuations are quite high, and in some cases they are, there's actually quite a bit of dispersion in the market right now. And so what you see while growth or very growthy companies are in high demand and are seeing some pretty high valuations, in both trading levels and acquisition levels, there's a pretty wide spread. So if I were to take the S&P, for example, what you'd see is the top 10 mega cap companies, are up 35% already this year. The S&P as a whole is up 3%, but the other 490 are down 6%, and the bottom 100 performing companies in the S&P 500 are down over 40%. So there are a lot of very interesting companies, not directly COVID hit companies, that are just not as sexy from a growth standpoint, that are trading at pretty attractive valuations right now. So I do agree with Raymond, in that this is a very interesting time to be deploying private capital, and would think the next 1-2 years will be quite active and quite attractive when you look over the next 3 to 5 years.
Would you describe your posture as aggressive or cautious?
Well, a little bit of both, perhaps, right? I would guess of all the panelists, we probably have the most conservative outlook on how fast the economy is actually going to recover. But having said that, you can bake that into your underwriting. And so if you bake a conservative set of outlook into your projections and into your analyses, you can then afford to be aggressive in those situations that look attractive.
Well, since you drew the comparison, Scott, I have to turn it back to the panel for a moment. I suppose Apollo's view on the economy and the prospects for economic recovery are a little more public, or maybe not so much so than Eurazeo's, but a little more public than maybe we might get from InvestCorp, or we might know from BC Partners. Does anybody else want to take up this question of the economic outlook, the fundamental underpinning, to the economy and ultimately to the companies in which you're thinking about investing?
I'm happy to jump in.
Just for a second, as Scott was mentioning, the big difference between 2020 and the great financial crisis is about dispersion or polarization, either geographically or by sectors. So you can look at overall economic forecasts, which clearly shows some of the winners, including China, as I mentioned earlier. But the reality is that you have to go down very granularly. And in any country, take France as an example, I think the forecast for this year in terms of growth is minus 9.8% GDP. But the reality is, depending on where you invest, you will find and you will be able to find growth, because companies being French-based or French headquarter or French created, they either have a good positioning in some sectors. Healthcare was mentioned by Raymond, very rightly so. I mean, there's a big awakening about health safety and, health first. A lot of growth in here, although the environment is pretty doomed in France as a whole. And same thing for companies which have international presence. So this dispersion, this polarization that we have creates significant opportunity and really puts us as an industry where we like to be, which is exercising our judgment on a case-by-case basis with our expertise, our savoir-faire. And we've always been very good at that, sometimes with very contrarian position and not going with the crowd or with the majority. And also, last point, quickly, let's remind ourselves that our underlying market, the number of companies which are under private equity ownership or willing to join the crowd, and the size of what we account for on a GDP basis is nothing, much bigger than what it used to be back in 08 or 09. Statistics tells between 6, 7, 10, 12%, depending on different countries, of GDP being owned by private equity players. So we are evolving in a very large market, offering various opportunities across sectors, geographies, and cycles as we speak today in 2020. So very interesting moment.
Before I move on to the next question, does anyone else have anything to add on whether you are or are not bullish about the prospects for the economic recovery out of this pandemic?
I would just say quickly, I'm totally where Scott is. I personally believe that, from an economic standpoint, we still, particularly in the US, a bit in a bubble, in the sense that obviously there was a strong decline in Q2, and then the economy recovered. And what I don't think has worked through the wheels of the economy is all of the impact of the government support, loans to businesses, support to individuals. Where in the US, typically when you're laid off, unfortunately, you don't have a lot of support, and and that has created a bit of a bubble. And so to my perspective is the economic recovery is going to be slow. It's probably going to be more painful than people necessarily imagine at this point in time. Simply because, just look at all of the crises in the past. It does take a long time to get out of it, particularly in an environment right now where the central banks have used, pretty much all of the tools at their disposal, to prop up the economy, and the level of debt leverage of most countries getting out of the pandemic, is very, very high. So the margins for maneuver are much more limited than they were 10 years ago.
I mean, just quickly to add to that, if you look at in the financial crisis, LIBOR was 5.25, and it's now circa 25 bips. So the macro levers are clearly very, very different than we were back then. And I'm probably more where Raymond is in terms of caution on the U.S. recovery specifically for the reasons he cited. I mean, we still have over half the jobs lost still not returned. But having said that, in our markets, there are a lot of opportunities, and there are a lot of secular trends that we try and get behind, that maybe the growth rate slows a bit during a downturn, but that long-term secular trend, whether it's demographics, health and wellness, et cetera, those trends will persist. And those are the opportunities that we look for. And I think there are a lot of them. And the beauty of the market is, Scott's absolutely right. There's, with respect to dispersion and investment approach, there's a lot of different ways to try and create value.
David, I'm going to stick with you for this next question, to kick us off at least on this next question. Every private equity investor, and to a certain degree, every investor has to make a decision about whether to touch industries, sectors, companies that have been directly or indirectly, but all the same, severely impacted by the pandemic. Talk to me about, whether or not you are prepared to run into the fire Are you investing in COVID hit companies? And if you are, how do you think about that?
Sure. It's a great question. And the answer is yes, if it falls within our sectors. We focus on six service sectors. And what we look for, and we are looking at a couple currently, are businesses that we don't think are permanently changed as a result of COVID. And obviously, a lot of businesses have had short-term and pretty severe demand impacts. But I think most of us would agree a lot of that comes back. Some of the further out, the airlines, the hospitality, that's much harder. But if it's in a fundamentally sound sector that, again, we can get comfortable and conviction around those secular tailwinds, we will do that. And we will look at our best judgment on how do you normalize earnings and what is that ramp of recovery. And again, we'll probably be a little bit more conservative, but we'll think about a range of outcomes as opposed to kind of the false precision of a 5-year outlook.
I want to hear from everybody on this subject. Virginie, is Eurazeo running into the fire? And if not, how do you think about it? What is it that David mentioned hospitality and airlines. What else is off limits?
Well, for us, hospitality is not off limits. We like hospitality. We've been investor in hospitality for the last 15 years. We were not a heavy investor when the crisis started. Probably a better place to be. But now there is a lot of opportunity that presents, and not to go in detail about hospitality. I mean, you have many different types of hospitality, which are not dependent on the same trends, either structural or type of travel. So I think we at Eurazeo have a pretty deep knowledge about hospitality over the last 15 years. So we know what we might feel comfortable with and where I would jump in the fire. And, to David's comment, you have to have some time ahead of you because you have no visibility whatsoever. April, we thought we would be back to normal in September. We are now thinking January, but in the US, very different mindset and spirit than in Europe. We're all back at our offices in Europe, and we have been for many, many months. And that's a very different, atmosphere in the US where I go, regularly. So I'm just saying, hospitality is interesting. Leisure for us, and leisure travel related to leisure is also of great interest. But have some time when you make that decision to invest, and maybe don't feel that your old analysis or KPI and timing wise and recovery wise would apply, because we're still in an area of complete uncertainty. So give yourself more time to be certain that you're effectively going to make money on that investment and ride the cycle when it's back, or ride the growth when it's back. But yes, absolutely, we like a number of those sectors. And what else? I mean, there are some sectors which you might not have expected they would be impacted, but they have. And I believe this is going to be completely temporary, and that we will see growth again pretty fast. I give you an example which I thought was a little bit out of expectation. Some healthcare companies providing and working with surgeons, that worldwide the surgery planning have been postponed for months, either because clinics and hospitals were obviously needed to treat COVID patients, or because consumers don't want to go to the hospital anymore. I was personally not expecting in the sort of equity case where we invested in some of these, that we would be impacted that much. There are a number of companies in Europe or in the US where they will need capital to make sure that they can either consolidate the industry or join, forces which they need, and significant shareholding structure. So it's not just about leisure and travel and hospitality. There's other area of great potential that we're looking for as we speak.
Raymond, back to you. Do you feel similarly to Virginie that there is opportunity, leisure, hospitality, travel, and the like, and that's what you're talking about when you said earlier that there will be great opportunities, to buy companies at good prices in the next 1 to 3 years?
Well, I think at BC at least where these sectors are not sectors where we've invested very, very heavily over the past 10 to 15 years. These are, clearly in hospitality, the question is, how fast is demand gonna grow again? Are customer behaviors gonna change dramatically? Take travel for example. Is the level of business travel post-pandemic going to be the same as pre-pandemic? Most probably not. The question is, by how much and how impact airlines as an example. So, to use your expression, Erik, I don't think we're going to run into the fire. Could there be opportunities in those sectors? I'm absolutely sure there could be. And I think, as always, you need to use judgment. Try to see if you have an angle, build conviction. But as Virginie said, I'll give you another example. We have a portfolio company in Italy that is the largest chain of dentists. And you would think that obviously something like this has not been affected by the pandemic, except that when Italy went into lockdown, all of the dentist offices were closed except for urgencies. So, personally, at least, I think you have other than, we go to look at those sectors like this, as opposed to airlines as a first point of call. Now, does it mean that, we're never going to look into hospitality and leisure? Absolutely not. Take amusement parks and stuff like that. I think, once the pandemic is over, at some point, hopefully we're going to have a vaccine and people will go back to Disneyland and a bunch of other parks, which, are entertainment and effectively content types of businesses. So, that's the answer I would provide on this one.
Thank you. Scott, over to you on that question about, and I'll running into the fire, whether you think it's a good, an apt analogy or not.
Sure. Well, look, like everything, you have to, have a good understanding of the underlying end markets. But no, we haven't been deterred by many COVID hit markets. In fact, airline, aerospace, aircraft has probably been a place that Apollo has invested. I was doing the math in my head as we were talking. Probably approaching $5 billion over the last 6 months across, not just in equity, in credit, in structured credit, structured equity. So there are, very interesting opportunities, and we think that that's only more to come there. We haven't yet felt all the pain that some of these sectors are seeing. It really comes down to what I said earlier about setting your expectations right. I hope Virginie's right, and January is the point at which we're back to normal. But when we look at some of these sectors, we're literally modeling 2023 looking like 2019. So could be that far away, in some of these sectors. And then of course there's some other sectors that were facing secular problems even before COVID, and COVID just accelerated that. Retail, a lot of segments of retail, of course, comes to mind. But even some other places, commercial real estate. There's lots of commercial real estate that, is fundamentally under strain right now, but 0% interest rates have kept that propped up for some time. We are watching that space very closely, because we do think certain subsegments of that broadly defined, commercial real estate will see some real shakeouts over 12, 18, 24 months as, cheap liquidity eventually can overcome, just true fundamental demand problems.
Whether they are in the COVID crosshairs, so to speak, or not, the reality, of course, is that many companies are struggling. Many sponsor-backed companies are struggling and finding that the liquidity that they were able to secure in the early months of the crisis is proving insufficient, and they need more money. This situation, as I think all of you know to varying degrees, has turned the distressed market into something, the distressed credit market into something that resembles the Hunger Games. In exchange for this new money, many borrowers are willing to cooperate, collaborate, some might say conspire with certain creditors to strip other creditors of their covenants, of their collateral protection, of their seniority in the capital structure. And I'd like to know from all of you, as a sponsor, how do you think about these situations? And I'm going to go back to you, Scott, because Apollo, by virtue of the scale of its business, has been on both sides of these situations more than once already.
Sure, sure. Look, I think you've described it right. I think even we have been surprised to some extent to the magnitude that some creditors and some companies have gone in interpreting documents. I never thought I'd hear myself say that, but it has gotten quite extreme out there. The look, I think some of this is a willingness to test some new waters. Not all of it will ultimately hold up. I think, through the scrutiny of court and or the bankruptcy system. But I think you should expect to see more and more of this as companies are willing to do lots of things to stay alive. And for better or for worse, the credit markets have allowed some of this behavior because of the looseness of some of the documentation that has sort of seeped into standard credit documents over the last last 5-6 years.
I'm going to ask you the same question I'm going to ask of everybody else. Is it okay? Is it okay to do that? Is it okay to say, because these are lines that, look, credit markets have always been, pugnacious places, but these lines haven't been crossed heretofore. Is it okay to work with one group of creditors or even a single creditor to get the money that your company, the company you have equity in, needs to survive, even if it means leaving the other creditors in the dust?
That's a simple question, but of course it's a complicated answer. It does come down to what capital structures look like. How many different layers there are. Are you talking about creditors in the same category, the same class, and how explicit or not were the underlying documents when that debt was issued? And so I think there are definitely gray areas. There's some, not to be evasive, but there are some times where I think it's pretty clear in the white zone. There are other examples that are pretty clear in the black zone, but there's a fair bit in the gray that I think the courts are just going to have to test out over the next couple of years as some of these companies do end up filing, and bankruptcy courts have to make heads or tails of what actually happened.
Raymond, over to you on this one. You know what it's like to be dealing with unhappy creditors. I don't have to take you back to PetSmart Chewy. This is a different situation, and I'm curious to know what your perspective is on these kinds of dynamics.
Yes, thank you, Erik. On PetSmart Chewy, thank God we've made all the unhappy creditors happy creditors in the meantime. So I think it all ended well on this one. Look, to me, it's relatively simple. Our job as equity holders, when we hold the equity, is to maximize the value for shareholders. And when things don't go right, because of a pandemic, because something doesn't go right on the investment, our job is to fight as hard as we possibly can to recover value and maintain value. In certain cases, it's going to mean making people unhappy, and we can't make everybody happy all the time. And our job again is to our LPs. Clearly, as Scott was saying, it is a matter of what is in the documents, what can you explicitly do, what can you explicitly not do, and in the middle there's a gray zone. I've been in those situations as you've reminded, and in those situations, unfortunately, very, very often you have people who are trying to, extort money from you and hold you up for ransom. They're not doing that necessarily when they have the right to do so. They're doing that because, they're trying to exert any piece of leverage that they have. So, as Scott was saying, it's kind of a gray area. And again, to me, what's the most important is we need to do the right thing for our investors. And if it means, making people unhappy, that's kind of our job. I'm not really concerned by this. We've got to do what we've got to do.
David, over to you. We've heard from both Scott and Raymond on the subject, and yes, it's complex. I acknowledge that, and it's not so easy to answer the question, would you or won't you? But tell me how you're thinking about it, and also whether it really is, at the end of the day, about the documents and about maximizing value for your shareholders, or is there if there two competing voices, one on each shoulder, is one of those voices saying, "Wait a second, we've got some moral standards to uphold here"?
Yeah, just a couple of thoughts to add to what the guys have said. And again, as a middle market investor, we generally put less leverage on our businesses, and they're more often than not club deals versus the broadly syndicated deals. So there are some differences. I would say a couple things. I fully agree with Raymond that we're stewards for our investors' capital, and we need to do. And every day we're working to earn an appropriate return for our investors, and that is our primary job in this respect. There's a much broader set of constituents and stakeholders that also need to be considered. So that's comment number one. Comment number two, I would say that, when it comes to the lenders, we're all sophisticated people with very sophisticated advisors, and the documents do matter. I also like to believe that relationships matter. And we saw in the crisis, I remember we were closing a deal in August of 2007, and the lender had underwritten a covenant-like deal and came back to us and asked for a covenant, even though contractually we had the right not to have one. We gave them one. Some people may say that was silly to do because we didn't have to, but I think have adopted the view that institutions may not have memories, but I think human beings do. So we do try to walk that fine line when we're in a tough spot, and there's not enough of a pie to satisfy everybody at a moment in time, to walk that line, and we will make compromises when we think it's appropriate.
Virginie, last word on this subject to you. How do you think about these things? How do you balance these considerations, maximizing returns, if you will, on the one hand, and playing the long game and worrying about relationships you may need in the future on the other?
Well, lucky enough, I didn't have that many experiences, and I hope it stays this way. But a few though, and also some back in 2008 and 2009. So maybe just a few comments to be sharing additional thoughts around that theme. The first one is about how quick we had to react and deal with liquidity issues, which came, at least in my own experience, much faster than it did back 10 years ago, which in a way helped a great deal because we didn't have much time to be playing the usual game and the tricks and the ransom part, which was Raymond was referring to, aggressiveness, hide your game, a type of approach. We had to find or not an agreement pretty fast this time, which I thought, of course, put you a lot of pressure on all creditors and equity provider, but we were all in the same time frame with the same pace. That if you don't find an agreement by the end, you'll end up losing on both sides everything that you've either invested or lended to the company. So that's one comment. More pressure, time was more of the essence even, and it really came quite fast for the companies which were either badly capitalized coming in the crisis or well capitalized but immediately stopped, like with no more revenues from one day to another, typically leisure and travel as an example. And maybe a second comment, which I like to share, which is more about what is the perceived value of that company by the different stakeholders, equity investors and lenders. And that's where the situation, really starts and how things evolve. It's about the assessment of the different parties as to the fundamental value long term of that company, and how the value between the different stakeholders should be apportionated. And the fight is even stronger and more difficult if there is perceived value in the company long term, but an enormous, power game and balance at the moment of the negotiation. And honestly, the stronger you are with either, willingness to reinvest, size of funds, balance sheet, you name it, the better negotiation you can handle and the less stress you have on your shoulder, which makes you a better negotiator. These would be
Well,
my
let me put
comments.
you on the spot. Would you have a problem? Would you have any reservations about a financing transaction along the lines of those that I've described, where, variously termed priming or up-tiering, where in exchange for money, presumably your portfolio company badly needs, you would allow creditors to engage in these maneuvers against one another?
We've not been part of anything like that so far, so I have no immediate reaction. What we've done is managing very complex, structure and lenders' objectives, which are not always the same, as we know, depending on your cap structure. And we've done it, as elegantly as we could so far, and hopefully with the same outcome that Raymond was referring to for Petco Shui, which is, happy creditor at the end.
Elegance, I'm sure, is something you're all striving for. Before I move on to the next question, it sounded to me as though somebody wanted to say something else. Go ahead. Perhaps
just on a more maybe
Go ahead.
positive note, and I don't know whether my fellow, friends can, weigh in on this one, because, 20 billion is the size of Eurazeo, so I'm not statistically, representing the whole market, and 90% of what we have is in Europe. But let's be honest, although we have no visibility for the future, we have to be, careful, and, it's going to last longer. But statistically, we've not had that situation in our portfolio. We have about 400 companies in the portfolio, let's say 100 which are sizable. We've only been dealing with a few, like less than a handful of situation to be renegotiating or being, in a difficult dialogue, shall I put it this way, with lenders or creditors. 1-2 situation out of a much larger portfolio. Is it because what David was saying, we've had less leverage and we've learned from our mistakes back in the good old days of the great financial crisis? Possibly. Is it because those companies came in the crisis, for most of those, with strengths of cash, strengths of activity, talented pool, team of management, all of the above probably, but statistically limited.
And did you have a question that you wanted to pose to your fellow panelists?
No, whether they shared my assessment that it's nothing near at this point in time what we've been through the great financial crisis in terms of number of companies which have been hardly hit, and maybe it's about the decision making and the portfolio composition and the investment strategy that we had, but so far much less impact than what I could see when I joined Eurazeo in the early 2008.
I mean, Virginie, just to
Go
answer, I'd say across Apollo's, 100 billion of equity and real assets, I'd say our watch list, what we call things we're watching closely, is under 2%. So it actually is pretty small within the portfolio. Yeah.
I'm going to jump in with another question because I want to give our audience an opportunity to ask something of all four of you. It's pretty simple. What do you make of the SPAC phenomenon? And are SPACs stealing opportunities from private equity? Who wants to take that on?
I'll jump in just because we recently just raised one. So maybe I'll step back and just give a 30-second just history of SPACs, right? So SPACs have been around for a very long time. You saw the beginnings of a large SPAC issuance in 05, 06, 07, but then the GFC came and really, put an end to that pretty quickly. You've seen a pretty low amount of issuance, in the 2010 to last year, basically a pretty steady but not very robust volume. And then this year, you've obviously seen just a massive explosion. But the question is this a bubble, or is this the emergence of some new type of asset class? I would say the latter. Ultimately, right? If you think about it from an investor's perspective, a SPAC is an incredibly efficient way for an institutional investor to access the private markets, from a traditional acquisition standpoint. And in a 0% interest rate environment, right, where an institution can, for a very low carrying cost, make an investment in a SPAC, have the SPAC go around, hunt for an acquisition, the institution then gets to vote, do I like that deal or do I get my money back? It's a very low cost way for that institution to be able to play the acquisition market. So I actually think as long as you believe we're going to be in a low interest environment for the foreseeable future, which we, and I think most people on this call would happen to believe, then I think you're going to see this stay for some time. As to the second part of your question, is it stealing opportunities from private equity? From our perspective, we don't really see it that way. We're targeting a slightly different set of companies, set of assets with our SPAC activity than we are with our traditional funds. So we've been able to really bifurcate the targets.
Who else wants to jump in on that point? Raymond, I thought I heard your voice. I'm curious to know from, in addition to what you make of SPACs and whether you think they're competing with private equity, I should add, given that Scott pointed out Apollo raised a SPAC, is a SPAC something you would want to raise?
Well, I would say, first of all, I totally agree with what Scott has said. SPAC is complementary to private equity. It is not in competition. You have to realize that if you raise a SPAC, first of all, you have a gun under your head, whereby you need to complete an acquisition or to sign an acquisition during a certain period of time. And usually SPACs are relatively small groups of people, and they don't have the ability or the bandwidth to sort of go in depth into many situations at the same time. And the time frame is very, very different. So, SPACs actually have been a great way for private equity companies to exit businesses, as you've seen, recently, and to exit businesses in an environment whereby institutional investors and the public markets have been relatively conservative, and a bit volatile as well. So, SPACs are, I would agree with Scott as well. They're here to stay. It's another vehicle for public investors to invest in the public markets. And I think for private equity, it's a great way to exit when the public markets are not as favorable. So, I think it's a very, very good development for the markets in an environment, again, whereby, as we know, for the past 20 or 30 years, the number of public companies has decreased dramatically. So, it's a good way to broaden access to the public markets for a lot of institutions and individuals.
That is a good reminder.
If I may, just to bring another angle to the SPAC discussion. as a seller, you have interest in investigating your ability to sell faster with process of diligence and which are much more similar to private transaction than public. So that helps. Business plan being provided and exchange, and you're not subject to public regulation. I don't know how long that will last, by the way. But a comment is about liquidity, and I've not been following statistically every SPACing and the performance after the transaction of the stock price and how liquid those stocks are. What I do know, having done in the last 10 years many IPOs of companies that we first invested in privately, is that liquidity is absolutely key. So you're not really exiting, as you know, when you're SPACing one of your company, because you retain a very big chunk of the capital. So you better make sure that the liquidity of that stock is sufficient to continue to exit if that's your plan, and make sure that there's sufficient interest from institutional investors so that your capitalization, your market cap, and your value effectively reflects interest from institutional investors as proper and is sufficiently deep to be really reflecting the value of your stock. There's nothing worse than being public with not much interest from investors, where your stock price is not where you would like it to see, and when you're stuck as an investor, plus the overhang on the stock. So if you want to be, making sort of some fun about it, it's probably some candidates in the future for public to private again.
Another good point. We only have a few minutes left. I want to come to each of you with this last question and ask you to try and keep your remarks to 60 to 90 seconds so that we can get in under the bell. David, there was a sense perhaps heading into 2020 that the increasing focus among investors on ESG and impact investing was something of a luxury that could be afforded in a very benign time for the economy. And this is not a benign time for the economy, and yet investors seem to be doubling down on their demands for ESG and impact investments. Tell me about your experience at InvestCorp and how you're building this in to your investing model.
Yep, I agree with you. I agree with your statement. It's not a temporary phenomenon, and it's all tied into the much broader discussion around where we are as societies across the globe, where we are politically, where we are in terms of development and opportunities. So we've been global from the beginning. Out of 450 people, we've probably got 45 nationalities. And as the nature of what we've done has always been more service and growthy, we've been probably more ESG than we were consciously trying to be in terms of the assets we invest in. But we're clearly taking it to the next level in terms of bringing in real expertise. It's a core part of all of our diligence now in every deal we do, and will become increasingly important, both internally but also for our companies and our investors.
Scott, Apollo has recently announced an impact investing business. So clearly this is front and center for your firm. How are you thinking about it?
Sure. Look, I agree with your opening statement there that this is proven not to be just some fad, but there's more demand than ever. With respect to impact investing on the private equity side, to date, most impact investing has really been focused on either venture-based or certainly growth equity. Our perspective here is that's all great. It's not an either or, but to really scale social impact, you're going to have to bring that to larger and larger companies, in a scale that makes sense. And so, our focus is really, how do we scale up impact? How do we, really deploy meaningful capital through asset selection and then active asset management once we own these companies to really drive impact. And we see this, while it's still, I'd say, a niche of the private equity industry right now. If you fast forward 10, 15 years, I can see a point where all of private equity is impact investing. And if you want to invest in dirty or certain industries, you're going to need a non-impact fund to be able to go do that. That's how much we believe this is really a trend, and we're trying to really get behind it.
Virginie, would you agree? And can you turn impact investing and a focus on ESG into something other than a niche today?
Of course. I think that was the one of the awakening I was referring to earlier in my introductory comments. ESG is an enormous wave as we speak, and that's a great news. We started 10 years ago, so I feel not only are we pioneer, but I want to remain, very much leading the way in terms of ESG. We've announced O+ about a month ago, and O+ for us is about zero net carbon emission for Eurazeo as an investment company, but more importantly for the group, so the 430 portfolio companies by 2040. I have a dedicated team of experts, climate engineers, which are only working on behalf of portfolio company to reach this. And it's a very, very technical, very serious approach. And it's about bringing that engagement, of course, but more importantly, that expertise, that know-how, that savoir-faire. How do you measure? How do you change your supply chain? How do you change your producing product from carbon to producing to biomass to photovoltaic to green basically energy. So we are embarking on reducing our greenhouse gas emission, and the second pillar is about inclusion, not just gender, not just race, but also social welfare, social protection for a large number of our people in the portfolio companies. This is a very exciting moment, and you bring it to everything that you do, the very core of what you do and the very core of your portfolio companies.
Raymond, do you share that excitement?
Yeah, absolutely. I mean, in addition to the excitement, frankly, I think we all have a responsibility here. The climate change, diversity, social inclusion and stuff like that is obviously something that is important to all of us. It's going to be important to our kids. And in our business practices, we have, a very, very important responsibility to try to, to further those causes as much as we possibly can. In addition to that, in a number of cases, it's also good business practices. Because, if you take diversity, for example, obviously, there's very, very few people who would disagree that having a more diverse pool of opinions and perspectives and stuff like that is going to lead to better decision making. Similarly, in businesses, ESG can lead to savings, can lead to more efficiency and stuff like that, and it's a good business practice in that sense. We own the 4th largest environmental services company in North America, and we're very, very attuned to this. So, not only am I excited, but I think it's a very, very important responsibility that we all bear. I wish governments would have the same sense of urgency there. And I think, Larry Fink and the public market and stuff like that have done great things and should continue to do great things to make it a better world for all of us.
With that, we conclude our Milken Global Conference panel on private markets. I want to thank our panelists, Scott Kleinman, Virginie Morgon, Raymond Svider, and David Taya for a terrific discussion. I do wish we could have had it in person, and I look forward to the moment in the hopefully not too distant future when we'll be able to do that. But in the meantime, on behalf of the Milken Institute, ladies and gentlemen, I'm Erik Schatzker of Bloomberg Television. Thank you for joining us.
Thank you very much.
Thank you.
Thank you.